Current market status, closed. The UnitedHealth Group Inc., NYSE UNH, finished the last trading session on Friday at $341.84 USD, registering a solid intraday gain of $5.11 USD, or 1.52%. This price action is deceptive. If you're just glancing at that green number on your screen, you might assume it was a quiet, easy victory for the healthcare giant. But that assumption would be a mistake. The reality is that UnitedHealth Group is currently sitting at the center of a massive storm, one that contradicts everything we typically assume about this stock. The general expectation for UNH is that it is the ultimate sleep-well-at-night stock, a boring, defensive compounder that you tuck away in a retirement account and ignore. It is supposed to be the bedrock of safety. But the reality, UNH has become a battleground. It is currently trading roughly 40% below its 52-week highs, battered by antitrust regulators, cyber attack aftershocks, and a fundamental shift in how the government pays for healthcare. Yet, and this is the critical insight that most headlines are missing this weekend, while the broader tech-heavy market, including darlings like Nvidia stock and Tesla stock, sold off into the close on Friday, UnitedHealth rallied. It gained nearly 6% over the last week, while the S&P 500 dropped. The market is whispering that the bottom might finally be in, and that the fear trade has gone too far. This divergence between the terrifying headlines and the bullish price action is where our opportunity lies today. Let's break down exactly what happened in the last few sessions, because the nuances here are critical for anyone holding this position or thinking about entering. The tape on Friday was telling us something important. While investors were dumping high-growth names, seeking liquidity, money was quietly rotating back into UnitedHealth. Why? Because the market hates uncertainty more than it hates bad news. We finally got clarity on the Department of Justice's stance regarding the Amedisis acquisition. For months, the fear that regulators would block this deal and perhaps break up the Optum unit entirely hung over the stock like a dark cloud. That cloud just lifted, albeit slightly. The court approved a settlement where UnitedHealth will divest certain assets to satisfy antitrust concerns. The market looked at this loss of assets and treated it as a massive win because it removed the existential threat premium that had been priced into the stock. When you see a stock rise on what looks like bad news, having to sell off assets, it's a classic sign of seller exhaustion. The sellers are done. The bad news is priced in. However, to understand if this rally has legs, we have to look at the volume and the institutional flows. We saw roughly 8 million shares trade hands on Friday, which is healthy and above average. This suggests that institutions, the big players managing funds at places like Fidelity Investments or using sophisticated tools like Schwab Intelligent Portfolios, are stepping back in. They're likely looking at the valuation, which has compressed to a price-to-earnings ratio of around 17, and realizing this is a historic anomaly. Usually, UNH trades at a premium. Right now, it's trading like a distressed asset. But is it distressed, or is it just misunderstood? The narrative has been dominated by the fallout from the Change Healthcare cyber attack earlier this year and the subsequent dragging of executives before Congress. That event was costly, no doubt. It disrupted cash flows and terrified the market about the vulnerabilities in the U.S. healthcare infrastructure. But look at the cash flow statement from the latest quarter. The company is still generating massive operating cash flow, affirmed at over $32 billion for the year. The broken business narrative doesn't align with the cash-printing machine reality. This is a good moment to pause and ask yourself a hard question about your own portfolio psychology. When you look at a chart that looks like a falling knife, do you see a trap or do you see a sale? Comment below with value trap or value play and let me know how many shares of UNH you are currently holding or watching. It's interesting to see where the sentiment really lies among individual investors versus the big banks. Now, let's widen the lens and talk about the business itself, because many people trade the ticker without understanding the engine. UnitedHealth Group is not just an insurance company. If you think of it just as insurance, you're missing half the picture. It's two distinct businesses, UnitedHealthcare, the insurance arm, and Optum, the services arm. Optum is the real jewel here. It includes Optum Health, care delivery, Optum Insight, data and analytics, and Optum Rx, pharmacy benefits. The reason the stock has been such a monster winner over the last decade is the synergy between these two. UnitedHealthcare collects the premiums, and then it directs that spending to Optum services, keeping the money in the family. It's a vertically integrated healthcare machine. This efficiency is exactly what makes it a great stock, but it's also exactly what paints a target on its back for regulators in Washington who scream monopoly. The expectation is that this regulatory pressure will crush their margins. The reality, however, is that UNH has scale that no one else has. When Medicare Advantage rates get cut, as they have recently, smaller insurers get wiped out. They can't absorb the hit. UNH, with its massive balance sheet, can. In a perverse way, these difficult regulatory environments actually strengthen UNH's moat because they kill off the competition. We also need to discuss the macroeconomic backdrop. We're in a strange economic moment where interest rates are fluctuating and consumer data is mixed. In this environment, where do you put your capital? You might love the volatility of Robinhood crypto or the excitement of trading fractional shares on the Robinhood app, but the smart money often uses those platforms to buy stability during uncertain times. Healthcare is non-cyclical. People get sick whether the GDP is up 3% or down 1%. This defensive nature is why we're seeing that rotation I mentioned earlier. As investors get nervous about the high valuations of Apple stock or the cyclical risks in semiconductors, they look for places to hide. Healthcare, at these depressed levels, looks like a bunker. It pays a dividend that, while not huge, around 2.5%, is growing rapidly. Dividend growth investors love this setup, a beaten-down price boosting the yield coupled with a company that raises the payout by double digits almost every year. Let's talk about the competition and the sector peers. If you're using a tool like Interactive Brokers trading platform to pull up CVS Health or Humana alongside UNH, you'll see they're all suffering, but UNH is holding up better fundamentally. CVS has its own issues with retail shrinkage and pharmacy struggles. Humana is overly exposed to Medicare Advantage. UnitedHealth is the most diversified of the bunch. It's the best house in a bad neighborhood. But being the best house doesn't help if the whole neighborhood is flooding. The flood here is the medical cost ratio, or MCR. This is the metric that keeps analysts up at night. It measures how much of the premium dollar is actually spent on medical care. Post-pandemic, people are going to the doctor more. Surgeries that were delayed are happening now. This drives the MCR up and hurts profits. UNH warned us about this, and the stock tanked. But the recent data suggests this trend is stabilizing. If the MCR stabilizes in 2026, the earnings leverage to the upside is enormous because the stock is priced as if costs will spiral forever. This brings us to the self-investing angle. If you're managing your own money, perhaps through a SoFi active investing account or a Fidelity brokerage account, you have to decide on your time horizon. If you're a trader looking for a quick flip, UNH has momentum right now coming off that Friday bounce. The technicals show a double bottom formation around the $320 level. It held that support twice. That's a bullish signal for traders. But if you're an investor, you're looking at 2026 and 2027. The thesis for the long-term holder is that the current political headwinds are temporary noise. Presidents change, DOJ officials change, but the demographic trend of an aging population needing more healthcare does not change. UNH is positioned to tax that demographic trend better than any company on earth. I want to touch on the retail versus institutional dynamic again. We often see retail investors chasing the shiny objects, buying high on hype. You see this on social threads discussing Robinhood investments or SoFi stocks. But the institutional order flow, which you can sometimes infer from the dark pool prints and block trades, has been accumulating UNH in the $320 to $330 zone. They're soaking up the supply from panicked retail sellers. When BlackRock or Vanguard increases their stake, they're not doing it for a 2% gain. They're doing it because their models, likely much more complex than the standard Fidelity wealth management tools available to the public, show a deep dislocation between price and value. They're betting on mean reversion. Mean reversion is a powerful force. It simply means that things that have gone too far in one direction tend to snap back. UNH trading at 17 times earnings when it usually trades at 22 times earnings is a stretched rubber band. What could go wrong? We have to be honest about the risks. The government could block future acquisitions, stalling growth. The Change Healthcare hack could result in larger than expected fines or class action lawsuits that drag on for years. There's also the risk of a public option or more radical healthcare reform, though that seems less likely in the current political climate. And we cannot ignore the technical